This morning we have the pleasure of being joined by Gerald Stack, who's the head portfolio manager for the Magellan Infrastructure Fund. And we're going to ask him some questions about where he sees the market at the moment and how his portfolio is going to be positioned to deal with the current market conditions we have. So welcome to this morning's video. Gerald, thanks for joining us.
Andrew, thanks very much.
As a matter of introduction, can you explain how your infrastructure universe differs from a lot of your peers?
Sure, Andrew. I guess when we think about infrastructure and the way that investors have generally defined infrastructure, they've done it by virtue of its physical characteristics. Everyone sort of knows what infrastructure is when they look at it. It's a big, ugly piece of capital equipment that you need that provides an essential service. So the definition has historically been around that essential service, the assets that provide services that are essential for the efficient functioning of communities. And if you look around the world, there's probably about 300 different companies, 350 really, around the world on listed markets where more than 50% of their revenues are coming from these essential assets. And that's typically the way that that infrastructure has been defined. What we do is to say, okay, that's kind of interesting. From our perspective, the beauty of infrastructure, the magic of infrastructure is the fact that it delivers you very reliable, predictable earnings over time. It's not a get-rich-quick scheme, but it's a very reliable source of earnings over the medium to longer term. And it's reliable because of that, because they're providing essential services. So we look at that potential universe of 350 companies and we apply a second test. And the second test is that there's no external variables that affect the underlying earnings or cash flows. And by that I mean, you can have a company that's providing an essential service, but for reasons that are outside of its control, typically things that impact price, despite the fact that it has reliable demand for its service, it doesn't face reliable revenues and therefore reliable earnings into the future. And so, for example, many of your clients will have heard of the shale revolution in the US, where through fracking, through new production techniques, oil and gas companies have been able to access oil and gas deposits in different basins that they haven't been able to access. And because of that, there's a lot of oil and gas available. And what that has meant for infrastructure investors is that it's given rise to the development, the building and the construction of a large number of oil and gas pipelines in the US. And these oil and gas pipelines look and feel a lot like infrastructure. That is big, ugly piece of capital equipment, a lot of capital expenditure up front, and you get a long series of cash flows into the future if you own the pipeline in compensation for your capital expenditure. Now, the trouble that we have at Magellan with these companies, as much as they look and feel a lot like infrastructure, the revenues that these companies typically earn are tolling the value of the oil or the gas that comes through the pipeline. And therefore, as the price rises and falls, the oil price, so do the revenues and so do the earnings. So as much as they look and feel a lot like infrastructure, our concern with these assets is that we are not in the business of forecasting oil prices. This is absolutely not a skill that we have at Magellan. And indeed, as I look around the world, it's not abundantly apparent to me that anyone has that skill. But be that as it may, it means that the revenues and earnings are not reliable, they're not predictable, and therefore they don't deliver to what we're after for our investors over time, reliable, predictable earnings. So we screen those companies out. Similarly, we screen out anything that faces competition. That means that ultimately prices are not reliable. The best example of that's probably power generation. I think we'd all agree, particularly in a time of COVID, that having electricity is reasonably essential service. But the price of electricity fluctuates a lot. In Australia last year, calendar 2019, the price of electricity was around about $90 a megawatt hour, the wholesale price. Different in different states, but around about $90 a megawatt hour. Now, compared to that average price of $90, the maximum price was about $14,000 a megawatt hour. So from 90 to 14,000, and the minimum price was negative $500. So you've got this price which is all over the place, albeit it's an essential service. And therefore, if you've got a price like that, then again, revenue is not reliable, earnings not reliable. It doesn't make them bad investments in the long run or indeed bad companies. It just means that we don't know where the value, where the earnings are, and therefore we don't know where value is. So we avoid competition. We avoid anything with commodity price. The third thing we avoid is sovereign risk. And sovereign risk really in our environment means no China. No China, no Russia. Again, the nature of infrastructure is build a big, ugly piece of capital equipment, a lot of capex day one, long series of cash flows into the future. So therefore, having done that, if you own the asset, the last thing you want, having built all that asset and spent all that money, the last thing you want is for the government to come and take some of that away from you, your future cash flows. And unfortunately, the Chinese government has an unfortunate habit of doing that from time to time. And I might add that this happens in democratic jurisdictions as well. But in a democratic OECD jurisdiction, you're typically going to be able to rely upon the rule of sovereign law to protect your rights and your interests. So in China, good luck with that. Russia, probably not what we want to rely upon. So those sorts of jurisdictions we're going to avoid as well. So from a potential universe of 350 companies, we end up with about 130 companies with about $1.5 to $2 trillion US dollars worth of market capitalization. So in total size, it's about the size of the Australian Stock Exchange. Smaller number of companies, but larger average size. And of that universe of 130 companies, about 60% sits in the utilities bucket and about 40% in the infrastructure bucket, infrastructure being toll roads, airports, rail, communications infrastructure, and energy infrastructure, pipelines where they're tolling volume of oil and gas rather than value. So Australia's APA group, just sort of the pipeline, gas pipeline network that moves gas around the country. That's an example of an asset that meets our criteria on the infrastructure front. So they're the two. That's the essence of our universe. It's not a particularly sexy universe. It should be generally pretty reliable and boring. This year, 2020 has unfortunately had a little bit too much excitement. And no doubt we'll talk about that a little bit in a minute. But in essence, over the longer term, we're not expecting to get rich in a hurry out of these businesses. They should deliver you sort of inflation plus 5, let's call that sort of 7-ish% per annum, and even with the coronavirus and the economic crisis, we'd still be confident that that's the sort of returns you'll get out of these companies over the medium to longer term.
Thank you very much. So based on you just mentioning about the current market conditions, what are your thoughts on the current market conditions we're seeing? It's a bit of an unprecedented period in the global economy. Yeah,
absolutely. So let's talk about that a little bit differently for the two different sectors. So as I said, utilities are 60% of our universe, infrastructure 40%. If I think about utilities, the nature of utilities, water, gas, electricity, is they're providing an essential service. They're natural monopolies, and therefore they're regulated by governments around the world. The price that they are able to charge for their services is regulated, and pretty much around the world it's regulated in the same way, and that is that the utility is allowed to price their service at a level that delivers them a fair return, and a fair return is normally around about let's call it around about 9%, probably in most jurisdictions today. So they're allowed to earn a 9% return on their capital. So if they've got $1 billion invested in the company, they're allowed to make a profit of $90 million. And they price their product so they get that $90 million. So in the event of something like COVID-19, they've got an underlying compact with their communities so that they don't overprice. They might have to put their prices up a little bit to make sure they continue to get that $90 million. They might, they're going to be some businesses clearly that are going to struggle through this period. So they might face some larger bad debts, and they may have some odd companies go out of business. Some of their customers might not survive through this. So maybe that profit comes down a little bit, but we wouldn't expect it to be significantly affected, certainly over the medium term. So these companies, the beauty of utilities is that they are very reliable and predictable and stable over time. As much as there may be a little bit of volatility in their results this year, we wouldn't expect too much. Indeed, as we've gone through the reporting cycle, as in they've reported their results in the first quarter of this year, what we've typically seen is that the utilities we look at have reaffirmed their guidance for this year. In other words, they've said their profits are going to be largely unaffected by this, and they've committed to their long-term guidance. They typically give you sort of 5-year a pathway for where their earnings might be going, and they've reaffirmed that. So, we would expect them to be largely unaffected, and certainly the evidence to this point would point us in that direction. That's not to say they won't be completely unaffected, but we don't expect any material impacts. So that's utilities. That's about 60% of our universe. The infrastructure world tends to be about transport. It's about movement of people or goods or data. So if I deal with the first one, data, communications infrastructure, Increasingly, I'm doing this webinar today from home. We're all increasingly working from home. So therefore, we're all finding, our mobile communications increasingly important and critical to what we do. We wouldn't necessarily see mobile communications as a winner here, but we see the underlying economic story, and that is mobile communications. Mobile phone towers are essentially vertical real estate. They lease out positions on their towers to the Telstras and Optuses of this world who put their equipment on those towers. Those towers are increasingly important, and there's more and more pieces of equipment going on those towers. And as we move indeed from 4G today to 5G, and we're sort of heading down that pathway already, that's going to mean more and more pieces of equipment for them to be leased. So that story is well known, but it certainly investors have come to appreciate it very much in the last, let's say, 3 months. And the story for those guys has remained pretty robust. So they've done very well in share price terms through that period. And we would continue to believe that the outlook for those companies is pretty positive. So then we move to rail, toll roads and airports, and I'll do them in sort of reverse order, if you like. I'll come to airports last. Rail, for us, the rail that we invest in is really industrial rail rather than passenger rail in the US. There are 5 major investable Class 1 rail companies in the US, and they have multiple lines of business, but essentially what you're backing is the US economy. So clearly in the short term, there's going to be some volume declines, and like all infrastructure, the equation is, the more volume that goes through, that you put a toll on that volume with a relatively fixed cost base. So volume over time is clearly important here. So in the short term, there's going to be a volume decrement. Volumes in recent months have been down around about 20%. It's expected that will be something of a short-term impact, as in we don't expect it to be down 20% forever. But there's, the period over which it returns to normality is something that we're watching very closely. It certainly, rail has had an impact in the short term, but you'd expect that the US economy will recover over the medium term, and rail will recover with it. So we feel reasonably comfortable about that over the medium term, albeit in the short term it's been impacted. Then now we move to toll roads. Toll roads sort of have 2 types of passengers, like cars and trucks. Car traffic had been down pretty significantly around the world, particularly in Europe. Trucks have been down significantly, but less significantly. So cars have been down as much as 80% on some roads. Trucks were probably more like 40% on average. Trucks continuing to move goods through the system, moving toilet paper to supermarkets everywhere. So trucks down a little bit less. We've already started to see traffic really recover in pretty much all markets. It's certainly not back to where it was, remains down reasonably substantially, but certainly coming back. And indeed, car traffic has come back quite quickly, and in some markets looks like it may even get above where it was prior to the crisis because of people's reticence to travel on public transport. They feel more safe in private vehicles. So we may see in the short term that traffic levels actually on toll roads get above where they were historically. Certainly, again, over the medium term, traffic, cars and trucks, we would tend to expect are going to be ultimately a function of population and economic development. And as the economy recovers, we'd be pretty confident that traffic will get back to where it was originally, with limited impact, subject to the size of the recession, assuming we have a recession. A recession could lead, obviously, to less commercial traffic, less trucks moving goods around the place. But over the medium term, we're reasonably confident about the outlook for traffic and for toll roads generally. The last one is airports, and airports are a bit more problematic. Clearly, we've seen basically the wipeout of aviation over the last 3 months. We're starting to see airline traffic come back in some markets. In general, in the European Union, we're expecting cross-border traffic to recommence in July. So we're starting to see traffic come back. It's going to come back slowly. In Australia, we'd expect some domestic traffic. We're seeing some domestic traffic already, and we'd expect that to start to grow through July and so on. Generally, the picture is that we'll start to see domestic traffic come back in most markets, then regional traffic. So for Australia, that means New Zealand and potentially the South Pacific, and then cross-border sometime after that. We expect that the cross-border traffic will take some time to come back. And clearly it's going to be pretty tough on airlines and airports. So I guess it's going to be a much more subdued recovery, a much longer term recovery. Our own forecasts are that we're expecting something of the order of a 4 to 5 year recovery period here. Now that's quite stark, because in the past there've been plenty of demand shocks that aviation has gone through. You think about September 11, the GFC, the failure of Ansett here in this country, the impact of SARS in the past. So there've been a number of these demand shocks, but in the past, aviation has typically rebounded back in a sort of a 6 to 18 month time frame. And so in other words, numbers have come back quite quickly. Whereas here, what we're saying is that we're expecting it to take 4 to 5 years to get back to where aviation was in 2019. Now, we may turn out that we're being somewhat pessimistic or conservative about that, but as we stand here today, that's a set of forecasts that looks sensible to us, and it's not inconsistent with what we're seeing out of the major aviation bodies, IATA, which is the airline lobbying body, and the Airports Council. So we're expecting much more subdued recovery. We do believe that in the long term, people will continue to travel, people will continue to fly. So we feel relatively comfortable and confident about that. If we think about the nature of travel and nature of different passengers, there's really 3 different types. There's people normally travel to visit friends and relatives. They travel for holidays, and they travel for business. That first bit, VFR, visiting friends and relatives, we expect to come back pretty quickly. We expect travel to come back shortly thereafter, if not at the same time. It's business travel that we're expecting to come back much more slowly. Businesses will have a duty of care to their staff. We expect much more reticent to embrace travel early on. And indeed, again, as we've all gotten used to using Zoom and Microsoft Teams and so on, we expect that virtual meetings are probably going to take a much bigger role going forward than physical travel. So we expect the airport business to come back much more slowly. So if I stand back from that, utilities largely unaffected. Within the infrastructure space, communications really unaffected. Rail, a shorter term impact. Probably toll roads, a medium term impact. Airports, we do believe they'll come back to normality, but it's going to take a little bit longer.
Thank you, Gerald. So where are you positioning your portfolio now to, consider those areas that there's probably going to be less demand for? And also where are you particularly seeing opportunities for your portfolio going into this new world post-COVID and our changing way of operating as business people or as consumers?
Yeah, so prior to the crisis, let's say 31 January, we were roughly 55% allocated to infrastructure, about 42% in utilities, maybe 41, 42%, and about 3 or 4% in cash. Today, we're about 45, 46% utilities. So we've gone from 42 to 46. We're about 43%, 44%, let's say 44% infrastructure and about 10% cash. So we've reduced our allocation to infrastructure. We've increased our allocation to utilities, and we're holding a little bit more cash. So much more defensive today. Where do we see opportunity? Well, we're seeing different things in different spaces. So in the utility space, as I said, that we think the business is largely unaffected. Share prices are down slightly over the period. So we certainly see opportunity there, but it's not, it's a richer opportunity than it was a quarter ago. But again, it's not really get rich quick. So we certainly see opportunity there. We see limited downside, but it's not something that is making our eyes water, as it were. In the infrastructure space, let me deal with airports first. Airports we saw come off significantly. We went from 18% airports, and today we're around about 8% airports. So we've reduced our allocation. We did retain interest in some airports where we felt they were well positioned to recover out of this. Okay, yes, it will take them a period, but we think they're well exposed to those parts of the traffic, of the passenger mix that we think are going to come back first. So domestic and visiting friends and relatives and tourism rather than business, and have low levels of debt. So, and we felt that they were sufficiently cheap that they were worth holding on to. So in particular there, I'm thinking about AENA, which is the Spanish airport system, and Auckland International Airport. But we have a much reduced position. Airports potentially could be quite cheap, but we're waiting to get a higher degree of confidence about the way that they come back before we allocate significant amounts of capital to airports. So we've reduced our opportunity set there. There is a wide range of outcomes when we think about airports, so we're just a little bit more cautious. We've certainly seen some opportunities in the toll road space, and we've allocated some capital there. We saw a number of toll road companies get kind of cheap, and we took the opportunity to buy some things there. We continue to, we've seen toll roads bounce back reasonably quickly, albeit there's been a lot of volatility around. And we're watching those share prices kind of carefully. And if we see that we think again that there's limited downside and the opportunity for upside, then that's what we're certainly looking for. And then in the rail space, probably akin to what we've seen in the airport space, we've seen some share price volatility. We think there's a wide range of outcomes. We're not rushing back to get into rail just at the moment. We have a position in rail, but it's a relatively small one. And then the final piece is energy infrastructure. Energy infrastructure, we've been relatively stable through the period. The energy infrastructure assets we're in are very high quality companies with large numbers of clients, large number of typically corporate clients with high investment grade credit. So this is APA, this is Enbridge in the US. So they may face short-term reductions in volumes or crimping of the volumes that are coming through their networks, but we feel pretty good about what they're exposed to over the longer term. So the particular opportunities we see are, I guess, in utilities. As said, it's a slightly different opportunity. And then for us, probably toll roads is where we've seen the next a big set of opportunities.
Interest rates play a significant role in the valuation of infrastructure assets. Can you explain why this is for our clients and what your views are on interest rates in the world we live in today?
Sure. So again, as I've touched on, infrastructure is you spend a lot of money up front on an asset, and you get a long series of cash flows into the future. Given you've got this long series of cash flows into the future, the way that you value those cash flows is if interest rates rise, the value of that cash in 10 or 20 or 30 years' time is much less. And similarly, as interest rates fall, then the value of that cash well into the future, the value of that rises to you today. So that's really the impact of interest rates. Rates go up, values go down. Rates go down, values go up. So what we're seeing today, when we think about interest rates, I guess the first thing is that we think about it in terms of a range. We're not trying to predict exactly where interest rates will be. We're trying to think about where we expect them to head. There's always going to be a range of potential outcomes. As we sit here today, compared to where we were 3 months ago, you know, we are in a low interest rate environment, and probably we've got a much higher degree of confidence that we're going to remain in that low interest environment for some time to come. And that really should be very supportive for infrastructure investments and their values over time. However, given the way that the COVID crisis has unfolded, and that is that the physical lockout of commerce, well, then obviously that's meant some pretty dire impacts for airports, to toll roads, for rail. So you've got offsetting impacts, but when we stand back from it, we would still remain, you know, much more confident than we were, say, even only 3 months ago. That rate, and even then, we would believe we're in a lower for longer environment. I think it's safe to say that our base case today is lower for a lot longer environment. You know, we struggle to see how rates are going to rise anytime soon. Now, that doesn't mean that they can't rise. There's always a possibility, a chance that they will, and we're watching that like a hawk, and we're alert to that possibility. But our base case is that it remains interest rates, that monetary policy remains very accommodating for a period in time, and therefore the value of these very stable cash flow streams, low risk but very stable, should be increase in market terms over time. Now, we haven't necessarily seen that to this point through the crisis. I've referred already to the fact that, utilities are still are not, there's a bit of a value opportunity in our view in utilities just at the moment. And so we're watching that to see how that plays out. We haven't necessarily seen that low interest rate impact flow through. And I'm painting this in simple terms. I mean, obviously, with all the monetary accommodation, with all the fiscal or the government action that's taken place, there is always a risk that inflation breaks out. If inflation breaks out, then we're going to have interest rates will be jacked up. So that's what we're alert to, and that's what we're watching. We struggle to see that at the moment. So therefore, accommodative monetary policy, loose monetary policy, low rates is our base case. But we need to be awake to the possibility that that's not necessarily the case.
So finally, today, Gerald, so what is your medium to long-term outlook for the infrastructure universe you invest in and in particular, how do you see the Magellan Infrastructure Fund performing over that medium to long term?
Yeah, so we've always believed that infrastructure should deliver you inflation plus around about 5%. That's the essence of what we expect. And we have no real reason to believe that it won't deliver that as we go forward today. Along the way, there'll be blips, both up and down. And we've certainly seen that over the last decade or so. We had the GFC a decade ago. We've got the COVID crisis at the moment. In between, we had some returns that were well in excess of our inflation plus 5. Looked over the duration, we continue to achieve inflation plus 5 and then some over time, and we would continue to believe that to be the case. So we remain pretty positive around the opportunities for infrastructure investment. And certainly, if rates remain low, we probably think that there's an even bigger opportunity in the shorter term. But over any longer term time frame, inflation plus 5 is what we would always be telling our clients to expect as a reasonable return out of an investment in infrastructure. And we've got no reason to believe any differently. In the shorter term, who knows? We've never tried to predict what markets are going to do in the short term. We try to understand what the possibilities will be, and there's a range of possibilities. In the short term, we don't know. There's no reason to believe that we won't deliver inflation plus 5 in the short term, but it could be more and it could be less. Over the medium to longer term, we'd be very confident of CPI plus 5, inflation plus 5.
Yeah, that was great, Gerald. Thank you very much for that.
Happy to do it anytime, Andrew.